Okay, the next thing I want to do is take you through one that's a little bit more complicated, and I'm not sure how well you can see this, but this is exercise 1-15, which is titled Missing Amounts from Balance Sheet and Income Statement Data. And so we're back to using the accounting equation, right? So we start with this premise that assets are going to be equal to liabilities and equity. Right, but we have to add another twist, right? Equity, one of the equity accounts is retained earnings, right? So retained earnings is part of equity. Now, remember that retained earnings, right, from 1 year is its net income minus dividends paid, right? Because it's the earnings that you have retained in the business. So if we look at all these items here, right, we've got beginning of the year assets and liabilities. We've got end of the year assets and liabilities. And then we have all the equity items, right? Because the equity piece in this example right, it consists of these 4 general categories. It's additional stock, right? So if more people invested in the business, that's where you keep track of that. It's dividends, which serves to reduce our retained earnings. And then it's revenues and expenses, which together, right, that's where our net income comes from. Okay, so in the case of Alaska, we had beginning assets of 400 and beginning liabilities of 200. So that means our beginning equity had to be 200 because assets equals liabilities plus equity. Okay. Now at the end of the year, we had ending assets of 800 and ending liabilities of 450. So that means that our ending equity had to be 350. 450 plus 350 is 800, right? So this means that between the beginning of the year, So this means that between the beginning of the year when we had 200,000 in stockholders' equity, right, and at the end of the year we had $350,000 in stockholders' equity, right? So we have an increase in equity of $150,000. That's the key. Got to figure out the increase or the difference, right? So that's step 1. Figure out the difference. Now, where did the difference come from? And I have to say that, when you know accounting, even if you don't know it like a true expert, when you know accounting, you can tell what's been going on in a company just by looking at the balance sheet and the income statements from one year to the next. It's pretty cool. Okay. So where did that $150,000 difference come from? Well, we know, right, that the difference is going to be due to additional stock plus the change in retained earnings. Okay, so let's figure out what the change in retained earnings are. Remember, retained earnings are net income minus dividends, right? So our net income was, I have my cheat answer over here. I'll put that away. Make it go away. It's not going away. Oh, there we go. Okay, so our net income this year was 175 minus 65, which is $110,000 in net income. And our dividends were 50. Right, so that means that our retained earnings are 60. Now our difference, therefore, in the equity, the increase in the equity, right? So we were increasing equity, but we only got $60,000 of our increase out of our retained earnings. That must mean then that we issued $90,000 in new stock to come up with a $150,000 increase in equity when we only retain $60,000 in earnings in the company. Okay, so that's how you do all of these different columns in exercise 1-15.